list. So I invite you, Devin, to just listen into the conversation that we're having. A quick comment from the management. Dr. Lal's posted a good set of earnings. The key highlight this time was the margin recovery to nearly 27%, which is well above what the street was expecting. Remember, competition is the key problem now in this space with the a slew of discounts that have come through. The fact that the company has seen a recovery in the margins is being taken with both hands. The company's non-COVID revenues has also clocked in a strong growth of 15% versus last year. Bharath Uppiliappan, who is the CEO at Dr. Lal PathLabs, joins us now to talk about that. Bharath, thanks a lot for joining in. First, I want to understand what's happening on the margin front. Is there some easing pressure of discounts from online players? And in terms of the margins, what is the band that Dr. Lal's can operate in for the rest of the year?
Good morning, and it is good to be on your show today.
Thank you.
Couple of points, like you rightly mentioned, and one of the anchors before you mentioned that the devil lies in the detail in our set of numbers. We had a good top-line growth, the highest ever top line of 534 crores, which came in at a 7.1% growth over the last year. And also, what I would call the non-COVID revenues came at 514 crores, which was at a 15% growth. Now, the way to look at these numbers is that from a YOY perspective, last year was a huge delta wave surge in the country, which carried on till Q3 in many parts of the country. And hence, a strict comparison of a YOY base is really not the best way to look at a set of numbers. We have been saying that you must look at these numbers from a sequential basis. And a sequential growth now in this quarter had been broadly in line with what we have seen, let us say, a couple of years prior to the COVID instance setting in this world. In that context, what we have really done is to continue to focus on the fundamentals of the business, which is all about driving test mix. It is about driving the super specialty portfolio, creating a differentiation in the marketplace, while actively managing the cost pressure, which has led to the margin profile, what we have really got.
Right. Bharath, hi, good morning. Give us some sense of what are the gross margins which are sustainable to you?
Yeah, we do believe that, our pre-COVID margin levels of 25-26%, normalized EBITDA margins are what we are really, keen to achieve, in spite of all the pressures which come into the business. So that is something which we are constantly working towards, on a longer term basis. And that is what we feel comfortable with.
Okay, all right, Bharath. So we got that mid-20s is what you're looking at. But Bharath, if you could give us a couple of more details. The suburban part of business, that's scaling up, right? Till what level do you believe that can scale up? Maybe if you want to give us a quarterly run rate. And also the non-COVID revenues, that's shown a good uptake. What kind of a growth are we working with out there? Double digit?
Can you just repeat your previous question? The first...
Suburban contribution. Suburban contribution. Yes. It's been scaling up. So what kind of a run rate are you looking at out there? And on the non-COVID business in whole, what kind of a number are you looking at in terms of growth? Will it be double-digit growth?
Yes. So I'll take the second question first, because suburban is a component of the overall growth strategy of the company, right? So what we are very keen is to come back to our pre-COVID growth levels of double-digit growth. So there are a lot of levers being pulled in the business on how do we get to that space. So one obviously revolves around, how do we grow our bundle test contribution in a very meaningful manner? How do we create differentiation in the portfolio? How do we create excellence in service delivery? How do we really get our super specialty tests moving forward? So there are multiple such levers in the business which we will try and activate, including geographic expansion into tier 3, tier 4 cities of India, to be able to shore up the volume numbers. Suburban is a very strategic acquisition for the West region. In fact, it's a fantastic consumer brand, which has a lot of equity in the marketplace, both among consumers and amongst doctors.
Bharath, Bharath, most of what you're telling us, we are aware of that. We were like a couple of numbers, right? We got your strategy in place. You've given us a bit of a background. Non-COVID business, what kind of a growth can we look at from there, and what kind of a scale-up are you looking at on suburban? Go ahead.
Yes, so we will look obviously for a strong double-digit growth number in suburban, because West market is been traditionally weak for us, with suburban and the Lal PathLabs test menu portfolio combination. we should be looking at a strong double-digit growth in the rest of the country, yes.
Okay, strong double-digit growth in suburban. Very quickly, have discounts gone down? Because there was quite a bit of competition in the last 5-6 months. Heavy discounts were being given. What's the status right now?
Wonderful question. So we have been tracking competitive pricing, and what we understand is that a lot of them were introductory or promotion prices, which are now slowly being withdrawn or moved upwards. We have seen evidence that the package prices or the one-off test prices, which were a deep discount, are slowly being inched up to what we believe will be sustainable pricing for all the players. This industry has a very high gross margin contribution the way we look at it, but also a very heavy, what I would call fixed cost structure. So it is not really possible to keep offering very, very low prices without fundamentally altering the value chain of this business. In the absence of any value chain, all the promotional pricing will obviously move out over a period of time, and which is what we really are witnessing at this point of time.
Bharath, the only thing is that this is a question we keep coming back to. In your assessment, the slightly longer term average realization per patient, right? Because of all of this, because even if the new age the startups, etc., they correct their pricing upwards and slash the introductory offers, even then, I mean, where they stand with their pricing will be far lower as compared to where players like Lal PathLabs, etc., are. So what is the impact longer term per patient realization is going to be because of this phenomenon? Briefly.
So it is assumed that because of the apparent pricing, their realization will be lower to us. But if you start to look at what really will make sense from a business perspective, you will start to see that the realizations have to match us over a period of time. There is no other way. The margins we get is led by the volumes we put in through the system and across a menu of tests. It is just not the top 10 tests, but a host of tests, about 3,500 tests, and the combination around that, which is really what the mix is all about. So it is not a 10 test, 20 test game. It is a 3,500 test menu across the length and breadth of the country. And that is what really gives this business a margin profile. It is just not an absolute per test pricing basis which will get us a margin profile.
Okay, Bharath, we've run out of time, but not out of questions. Thanks a lot for joining us and have a great day. That's the word coming in from Dr. Lal PathLabs. Devin Choksi is listening in. Devin, the company says that, a margin range of 25-26% is sustainable and discounts are not as high